Patrick from Perth, what can we do for you this evening?
Hi, Margaret. Thanks for taking my call.
You're welcome.
I'm wondering what you think. I've got up to about $250,000 to borrow from the bank to buy a house. I'm looking at a couple of areas in New South Wales, Nora, Orange and Bathurst that you've always mentioned in your show. And I'm also looking at a couple of other areas in Queensland, Red Bank Plain and Ipswich. Just I'm not sure which area is probably better for me to invest between $250,000 and $300,000.
Okay, well, Ben, I don't know if you're familiar with those areas. Red Bank Plains and Ipswich, 250 to 300 may not get you anything anymore. They've certainly gone up a fair amount.
A struggle.
Nowra, Orange and Bathurst, definitely that's the buy-in price, well below that.
Yep.
Are you familiar with some of those areas?
Look, I'm not familiar so much with Bathurst and the New South Wales areas. I've had a look at Ipswich. I had a look up there around 3 years ago, and I've been keeping an eye on that sort of location, and I know it's definitely come up as a location that's growing in interest. It's hit certain top 100 lists that we see floating around. So I'll probably ask the question of Patrick in regards to what's his goals. If it's income producing and he needs strong yields because of servicing elements to the mortgage, then obviously start looking at those sort of drivers in terms of rental availability and so forth. If it's for capital growth, then incomes are going to be also important in terms of pushing that affordability range. So you see capital growth come up into those locations. So some interesting areas. Do your research.
Michael?
I like all of those areas. Margaret, you know that I'm a former Queenslander, if one is ever a former Queenslander. But certainly Ipswich and Red Bank Plains have been good to investors. I particularly like Orange. I think Orange is a really solid town. It's got a lot happening there. There's very good industry, very good employment.
No water, but...
No, well, it's a little bit more tonight. Look, I think it's a really solid town. I like it a lot, and I think it's got some class about it. It's got that attraction to people that are wanting to be close to, a country location, but still accessible to the city. But most of all, I think it's got some very good employment prospects, and there's good industry and growth and development there.
Patrick, if I could just add to that, if it was 6 months ago or 12 months ago, I would have said definitely Ipswich, but I think that may be slightly out of your price range now. I think 320 is going to be the buy-in price there. Red Bank Plains is going to be similar to you, maybe even a little bit more expensive. That's closer to Brisbane than Ipswich is. Both of those areas are great from a growth perspective, but I think now the yields are a little low because the rents haven't moved quickly enough yet. Out of the other three, Nowra, Bathurst and Orange, Bathurst is probably my pick, although I do support what Michael says about Orange. The Cadia Gold Mine is going to be providing about 40 years of employment up there, and it's a very strong health and education area as well. There's plenty happening. Bathurst is only 30 minutes drive away, a little closer into Sydney, although that doesn't matter much once you get over the 2-hour mark. And they have very strong leadership in the council there and an awful lot happening, and you can get buy-in prices in Bathurst from under 200,000. So they're all good areas, and I think it's going to come down to the one that you can drive the hardest deal in, get the best bargain in. I'd be looking in all of them, offering in all of them and coming up with the best deal that you can possibly get. Kelly from Sydney, how are you tonight?
Margaret, thank you for taking my call.
You're welcome.
I have a bit of a legal question. My husband and I are purchasing our first investment property, and we've sought advice and been told to purchase the property in both of our names. But we're now being asked whether we would like to register on the certificate of title as joint tenants or as tenants in common. And I just wanted a little bit of an explanation as to what the difference is and what you would recommend.
Okay, can you tell me furthermore, are you both employed at the moment, Kelly?
We are, yes. I work part-time and my husband works full-time.
Are you in a similar tax rate? Do you pay a similar tax rate, or are you on a lower tax rate than your husband is?
We're in a similar tax rate at the moment.
Okay. And this is your first investment property?
It is, yes.
Okay. Michael, you might want to start with the difference between tenants in common and joint tenants.
Yeah. Kelly, joint tenants means that upon your death, the property will automatically transfer to your joint tenant. A tenant in common is a more separate type of title, which enables you to pass on under your will or under your estate your own interest in the property. So husband and wife buying a home together would typically do that as joint tenants.
Now, Michael, from a taxation perspective, if you want to have an unequal split in the property ownership because one income earner may be earning more than the other, a tenants in common arrangement also allows you to specify whether one party only owns 10 or 20% while the other owns maybe 80.
Exactly. You can have a tenant in common as to 1/100th, with the other party holding 99 out of 100, for example. So there is some flexibility there for estate planning and protection.
Okay, now Ben, from an income point of view, then it's often better to have the title held in the name of the person who earns the most income if there are some negative gearing benefits there.
Definitely, Margaret, and I think the most important thing that you've got to look at in that sense, Kelly, is basically what are the plans with the property? If you see yourself selling the property into the future, then obviously capital gains becomes a decision. If you see this property as being something you're going to hold indefinitely, the goose that lays the golden egg and continues to keep delivering income for you in your retirement years, then the capital gains issue may not necessarily be an issue for you. Obviously, a lot of people are told by their accountants that normally the higher income earner is the way to go in terms of minimising the tax because of a negative gearing potential. And I think from that point of view, that's certainly something that we also recommend, but also taking a long-term view in terms of what are your intentions with the property will determine the asset protection side and basically the way in which you want to move forward in this investment.
And Kelly, lastly, I also recommend that you think about the future in terms of what's going to happen to you. Quite often people take the property or the bulk of the ownership of the property out in the highest income earner's name without thinking about the fact that in 5 years' time that income position may change. Sometimes one party decides to leave the workforce, or another party, the part-time worker, might be planning to get some full-time work and might end up earning more than the other one. So what turns out to be a good arrangement in the first year or two could be a bad arrangement for the rest of the life of the ownership of that property. You really need to take a broad view and consider 10 to 15 years of ownership rather than just what's best for you in the next financial year. Well, that brings us to the halfway mark, but of course we still have tons of time left. We have to take a short break, but we're coming straight back. So if you have a question for anyone on the panel this evening, we can help you with just about anything. Call us on 1300 30 34 35 or email us at property@skynews.com.au.